Stop scrolling. Because what is happening in the UK housing market right now in May 2026 is something that every property buyer, every investor, every first-time buyer, and frankly, every person who owns a home in Britain needs to understand. And I am not saying that to grab your attention and then disappoint you with vague information. I am saying it because the data coming out of the UK property market this month is telling a story that most people are completely missing. And the people who miss this story are going to make decisions, or fail to make decisions, that they will regret for years. So here is what we are doing in this video. We are going deep on the UK housing market in May 2026. What is actually moving? What is stalling? Where the genuine opportunities are hiding right now? And what smart investors and buyers should be thinking about and doing in the next 30 to 90 days. This is not a surface-level roundup. This is a proper, thorough, honest assessment of where the market stands right now and what it means for you personally. Welcome to NestPath UK, the channel that takes UK property seriously and treats you like an intelligent adult who deserves real analysis, not recycled headlines. If this is your first time here, subscribe right now because we cover the UK property market with a depth and consistency that I am genuinely proud of. And today's video is exactly the kind of content that this channel exists to produce. Let us get into it. Let me start by doing something that I think most property content fails to do, and that is to set the scene honestly. Because the UK housing market in May 2026 is not a simple story. It is not universally booming. It is not universally struggling. It is a market of contrasts, of regional divergences, of specific opportunities sitting alongside specific risks. And understanding that complexity, rather than reaching for a single clean narrative, is the foundation of every good property decision you will ever make. So what is the overarching picture? Here it is. The UK housing market entered 2026 in a state of cautious recovery. After the turbulence of the 2022 and 2023 period, when rapidly rising interest rates squeezed affordability, transaction volumes fell sharply, and house prices in many areas softened, the market found a floor. Prices in most regions stabilized. Mortgage approvals began to recover. Buyer confidence, while still fragile in some segments, started to return. And as we move through May 2026, that recovery is continuing. But it is doing so unevenly, with some segments and some regions performing significantly better than others. That unevenness is the most important thing to understand right now, and it is exactly what we are going to unpack over the next several minutes. Let us start with mortgage rates, because everything in the residential property market flows from the cost and availability of mortgage finance. If you have been following NestPath UK for any length of time, you know that we have been watching this closely since the rate environment turned hostile in 2022. The Bank of England base rate, after reaching levels that felt almost unimaginable compared to the historic lows of the early 2020s, has been on a gradual but real downward path. And by May 2026, that path has delivered something meaningful for buyers and investors. Mortgage rates are not back to the sub-2% levels that defined the pandemic era. And frankly, most serious analysts do not expect them to return to those levels in the foreseeable future. But the 5-year fixed rates available to buyers with decent deposits have moved into territory that is beginning to feel viable again for a much wider range of borrowers. Where rates were in the 5.5% to 6.5% range at the peak of the tightening cycle, well-qualified buyers are now finding 5-year fixes in the low to mid 4% range from competitive lenders, with some products sitting even below that for buyers with larger deposits. Now, why does this matter so concretely? Because the monthly payment on a mortgage is the single most important variable in whether a buyer can actually afford to buy in any given market. A 1% reduction in mortgage rate on a $200,000 loan reduces the monthly payment by roughly $100 to $120, depending on the term. Over a year, that is over $1,200 of difference. Over a 5-year fixed term, that is $6,000 or more. That is real money. That is money that transforms the affordability calculation for a significant number of buyers who were locked out of the market 18 months ago and are now back in play. The return of these buyers to the market is one of the key dynamics driving the cautious recovery we are seeing in transaction volumes and in asking prices in the spring of 2026. Estate agents across the country are reporting increased viewings, increased offers, and in some segments, a return to competitive bidding situations where multiple buyers are competing for the same property. This is not universal, and I will be clear about where it is and is not happening. But the directional shift is real, and it is being felt across the market. Here is the first thing I want you to really hold in your mind as we go through this. The buyers who act in this window, while rates have come down meaningfully from their peak, but before prices have fully adjusted upward to reflect the improved affordability, are the buyers who are going to look back in 3 or 4 years and feel very good about their timing. The window between rate relief and full price recovery is always finite. It does not stay open indefinitely. And right now, in May 2026, there are parts of the UK market where that window is genuinely open. Let us talk about where those parts are, because regional performance is the story of this market update more than almost anything else. London is doing what London tends to do, moving in its own rhythm, influenced by its own specific set of pressures and dynamics, and telling a story that is often quite different from the rest of England. Prime central London, after a period of adjustment, is seeing renewed interest from international buyers. The relative weakness of sterling compared to several major currencies has made London property significantly more attractive in real terms to buyers from the Middle East, from Asia, and from the United States. High-end properties in areas like Kensington, Chelsea, Mayfair, and the better parts of the commuter belt around London are seeing sustained demand from this international buyer pool. But Outer London and the commuter zone tell a more nuanced story. Here, the affordability stretch of the 2010s and early 2020s, when prices rose to levels that created genuine value concerns, is still unwinding in some postcodes. Buyers are more cautious. Negotiation room exists on asking prices that simply did not exist a few years ago. For the right buyer, someone who is planning to hold for 7 to 10 years and who is buying in a location with good transport links and genuine community appeal, there are individual opportunities that represent strong long-term value right now. But the blanket assumption that Outer London always outperforms over the medium term is one that needs more careful scrutiny than it used to. The north of England is genuinely one of the most interesting stories in UK property right now, and it has been for a couple of years. Cities like Manchester, Leeds, Sheffield, Liverpool, and Newcastle are sitting at the intersection of several powerful trends simultaneously. And that intersection is creating conditions that serious investors are paying close attention to. First, affordability. Even after several years of strong price growth, residential properties in many northern cities remain dramatically more affordable than their equivalents in London and the southeast. The average house price in Sheffield or Leeds is a fraction of the equivalent in equivalent commuter zones around London. For buyers who can access the market, who have a deposit, and who meet mortgage affordability criteria, the entry price point in these northern cities is significantly more achievable. That means a larger pool of potential buyers, which means more liquid markets, which means easier exits when investors eventually want to sell. Second, rental demand. The northern cities are home to some of the UK's largest and most active university populations. They are home to growing professional services sectors, expanding digital and creative economies, and significant infrastructure investment. All of these factors drive sustained demand for rental accommodation from students, graduates, and young professionals. Rental yields in northern cities have been consistently stronger than in London for several years now, and that pattern is continuing in 2026. Third, capital growth potential. The gap between northern and southern property prices is one of the most discussed dynamics in UK property, and the thesis that this gap will narrow over time, driven by improving connectivity, the rebalancing of the UK economy away from its historic London centrism, and continued investment in northern infrastructure, remains credible and is still very much in play. Investors who entered northern markets 5 or 7 years ago have in many cases seen both strong yields and meaningful capital growth. The conditions that drove that performance have not fundamentally changed. Nestpath UK has always been clear about this. We do not tell you that every northern city investment is a guaranteed winner. Markets are more granular than that. The specific street matters. The specific property type matters. The proximity to good transport, good employment, good schools, all of these hyperlocal factors matter more than any regional trend. But the directional case for well-chosen property in strong northern cities remains one of the most compelling in the entire UK market in May 2026. Let us shift now to the rental market, because the dynamics in the rental sector are creating both a challenge and an opportunity that every property investor needs to understand. The UK rental market in 2026 is, in a word, under pressure. Sustained and significant pressure from the demand side, and that pressure is not abating. Here is the core dynamic. The number of available rental properties across the UK has been falling for several years. A combination of factors has driven this reduction in supply. The tax changes that began in 2016 with the restriction of mortgage interest relief for landlords, culminating in the full implementation that removed the ability to deduct mortgage interest from rental income before calculating tax, drove a significant number of smaller landlords out of the market. Many of those who sold did not sell to other landlords. They sold to owner-occupiers. The private rental supply contracted. At the same time, demand for rental accommodation has continued to grow. The affordability barrier to home ownership, even with rates having come down from their peak, means that millions of would-be buyers remain renters because they cannot yet access the purchase market. Household formation continues. Immigration, both of workers and of students, adds to rental demand. The result is a rental market in 2026 where the gap between available supply and active demand has produced rental price growth that is running ahead of general inflation in most UK cities. For renters, this is painful. For landlords and investors who are in the market with well-positioned properties, it is providing income support that underpins returns. And for investors who are considering entering the market, the strong rental demand environment reduces the risk associated with void periods and rent shortfalls, two of the biggest practical risks of owning rental property. But, and this is important, the rental market is also entering a new regulatory environment that every landlord and prospective landlord needs to understand thoroughly. The Renters' Rights Bill, which has been progressing through Parliament, represents one of the most significant shifts in landlord and tenant legislation in decades. The abolition of Section 21, the no-fault eviction mechanism that gave landlords the ability to end a tenancy without giving a specific reason, has been a central element of the reform. When this fully comes into effect, landlords will need to rely on specific grounds for possession if they want to end a tenancy. That changes the risk calculus of renting to tenants who subsequently prove difficult to manage, and it requires landlords to be more diligent in their tenant selection and tenancy management processes. This is not a reason to avoid investment property, but it is a reason to invest intelligently, to choose tenants carefully, to manage properties professionally, and to understand the legal framework within which you are operating. The landlords who have always operated professionally and ethically are, in many respects, well positioned for this new environment. The ones who relied on the shortcut of Section 21 to manage difficult situations are going to need to adapt. At Nestpath UK, we have always advocated for professional, ethical landlordism, not just because it is the right thing to do, but because it produces better outcomes for everyone, including the investor. Good tenants who feel respected and fairly treated stay longer. Low turnover means lower costs. Lower costs mean better net yields. The regulatory shift reinforces rather than undermines the case for high-quality property management. Now let us talk about something that I think is genuinely underappreciated in most May 2026 property market discussions, and that is the new build sector and what is happening with housing supply at a national level. Because the supply picture matters enormously for the long-term trajectory of UK property values. The UK government has made ambitious commitments to increase housing delivery to 1.5 million new homes over the current Parliament. Whether those targets will be met is a subject of genuine debate among planners, developers, and housing economists. The planning reform agenda that accompanies these ambitions, changes to local planning rules, recalibrated national planning policy framework, the release of some greenbelt land for development, has created movement and momentum in parts of the development pipeline. But the gap between planning reform and actual completed homes is measured in years, not months. And the structural undersupply of housing in the UK, particularly in high-demand urban areas, is not going to be resolved quickly, regardless of policy ambition. What this means for property investors is straightforward. The supply constraint that has been one of the foundational drivers of long-term UK house price growth has not been removed. It has been addressed at the margin. The long-term pressure of more people wanting to live in quality homes than there are quality homes available in the right locations, that pressure persists, and it continues to support the investment case for well-located UK residential property over a long-time horizon. The new build market itself is navigating a complex environment in May 2026. Developer incentives, help-to-buy type schemes, deposit contributions, stamp duty assistance are being used by builders to maintain transaction volumes in a market where buyers remain price-sensitive. For buyers, new build properties carry advantages in energy efficiency, warranty protection, and the absence of immediate maintenance requirements. For investors, new builds require careful evaluation because the premium above second-hand equivalent values needs to be justified by yield performance and capital growth potential over time. Let me give you something concrete now, because I think the most useful thing Nespath UK can do in a market update video is move from the macro to the actionable. So here is what I think smart buyers and investors should be doing right now in May 2026, based on everything we have discussed. If you are a first-time buyer, the window that exists right now, where rates have come down meaningfully, where some asking price flexibility still exists in certain markets, and where the help-to-buy replacement schemes and shared ownership products are available for qualifying buyers, is a real window. It will not stay open indefinitely. The affordability improvement of the past 12 to 18 months is already beginning to translate into firmer asking prices in the most competitive segments. If you have been preparing, if your deposit is ready, if your mortgage affordability is in place, then the advice from this channel is clear. Act with intention and do not wait for a perfection that does not exist in property markets. If you are an existing property investor reviewing your portfolio, May 2026 is the moment to look hard at your refinancing options. The rate environment has improved significantly from the peak and well-timed refinancing. Replacing an expensive short-term deal with a longer-term fix at current rates can materially improve the cash flow and profitability of your portfolio. Talk to a good mortgage broker. Do not rely on your lender's standard variable rate, and review whether the properties in your portfolio are still aligned with your investment goals. Some may have served their purpose and represent better capital deployed elsewhere. If you are a property investor looking to buy in 2026, the regional picture I have described should inform your geographic focus. Strong northern cities with large universities, growing professional economies, and accessible entry prices are sitting in a compelling position relative to their long-term fundamentals. Student accommodation, studio flats, shared houses, purpose-built units continues to offer yield profiles that outperform the mainstream residential market in the right locations. And the regulatory environment, while demanding more professionalism from landlords, is sorting the market in a way that rewards the better operators. The UK housing market in May 2026 is not simple. Anyone who tells you it is either does not understand it or is not being straight with you. But within its complexity, there are genuine opportunities for buyers, for investors, for people who are ready to act on information rather than wait for certainty. The market has always rewarded the informed and the patient. That is not changing. This is what Nespath UK is here for. Every video, every update, Every deep dive we produce is designed to give you the knowledge and the confidence to navigate this market on your own terms. Not to follow hype, not to be paralyzed by fear, but to make decisions that you understand and that you can stand behind. So here is what I need from you before you go anywhere. If this video gave you real value today, if it shifted something in how you see the market, if it answered a question you have been carrying, if it gave you one thing you are going to act on, hit that like button right now. It takes 2 seconds, and it genuinely helps NestPath UK reach more people who need this kind of content. Subscribe if you are not already here, because we are going to keep going deep on the UK property market every single week. And leave a comment below. Tell me what part of the May 2026 market is most relevant to your situation right now. Are you buying your first home? Expanding an investment portfolio? Considering your first investment? Refinancing? Whatever it is, drop it in the comments and let us have a real conversation. The UK property market in 2026 is moving. The question is whether you are moving with it or watching from the sidelines. This is NestPath UK. I will see you in the next video.